Welcome to Creamer Media's Resources Watch, a weekly video roundup of the events and people making and shaping the news in the mining industry. This week, Harmony swings to profit, declares a higher dividend. Vedanta aims to complete $1 billion investment in South Africa soon. And Mistra reiterates call for PGMs Exchange as hydrogen economy looms. Gold miner Harmony Gold has posted a 46% increase in production profit to just under 14 billion rand, or $774 million for the financial year ended June 30.
This financial year was a landmark year for Harmony. Not only did we again deliver against all guidance metrics, but our expansion into near-term copper took hold. We have built up an incredible momentum supported by an improved safety performance. Group lost time injury frequency rate per million hours worked improved to 5.49. This has remained below 6 for 2 consecutive financial years, the first in our 73-year history. This is a monumental achievement for deep-level mining in South Africa and affirms our commitment to improving safety. Gold production remained steady year on year. We produced 1.47 million ounces, which was towards the upper end of the guidance despite the closure of Bambanani at the end of the 2022 financial year. Underground recovered grades exceeded the upper end of the guidance, improving by 8% to 5.8 grams a ton. Our costs remained under control, with all-in sustaining costs below the guidance of around about 890,000 rand per kilogram. This was an increase of only 6% and well below our planned annual increase of between 8 and 9%. I'm very pleased with this achievement, especially in the current inflation rate environment. We deployed 2 billion rand in major capital towards our high-margin growth projects. On the back of the good operational performance, we generated 6 billion in operating free cash flow, an increase of more than 100%. This enabled us to maintain our strong, flexible balance sheet with net debt to EBITDA at 0.2 times. Although we are now in a period of high capital expenditure, it remains our goal to return capital to shareholders. This is in line with our dividend policy and alongside our overall growth strategy. I'm therefore delighted to announce a final dividend of 75 South African cents or 4 US cents as a result of the strong group performance in the 2023 financial year.
Vedanta Resources aims to complete its commitment to invest $1 billion in South Africa in the near future, although its plans are being held up by a lack of reliable infrastructure and energy security.
In 2018, when I came with Prime Minister Modi, he was sentimentally very attached because Mahatma Gandhi started his freedom fighting movement from South Africa. So he has asked me what investment we can do in South Africa, and he says, can we do big investment, not small? And I said, whatever you think, and we said $1 billion investment we'll make in South Africa and create a job, massive job. So that was the beginning. And then Gamsberg, we opened the mine and we have so far invested $500 million. We are going to invest another $500 million for a smelter and making the final product. Government been working with us and they have declared that zone as an export economic zone. And Northern Cape, you trust me, it was completely deserted, but it has a lot of potential and there was no job for the people. So we have been, government work with us and creating an industrial hub in that area because they have a human resource, they have a natural resource, they have a lot of female. We have taken almost 25-30% female, not only mining side, even for the administration, for the leadership. We have taken we have employed the 3,000 people now. We are going to employ another 2,000 people once the smelter is ready, and that will complete our 1 billion investment. It can happen very soon also. We need two things. One is the a power security. Power is a big thing, and we also alternatively looking, because alternative power, renewable power has a big potential in South Africa. We are today leading in India for producing renewable power. I have asked my people to look at not to be dependent. Both we work. One is the government is assuring us that they with their ESCOM is a beautiful company. Democratic country. No democratic country government does not run the business. ESCOM can be privatized. Trust me, it can have a huge potential. At least 50 to 100% more power can be generated.
Think tank, the Mapungubwe Institute for Strategic Reflection, has reiterated its call for the formation of a platinum group metals exchange in South Africa, given that many stakeholders are losing out on value that could have been created in a less volatile market system.
Now, all these call for capacities in South Africa so that as a country we can utilize the more than 70% of the reserves and production that we have to carve a rightful place for South Africa in the PGM value chain. Financial beneficiation, in our view, is a critical element and would present many benefits. These pertain, amongst others, to financial and marketing services, the management of electronic platforms, and of course, we believe commercial benefits for the stock exchange. In addition to all this, is the role that the country can play in price discovery. So, quite clearly, as the researchers point out in that book, there are many economic and human resource benefits that are attached to this initiative. So now, what then about practicability? The first and catalytic issue is about the appropriate policy environment. And in this regard, both during the research and in the consultations that we undertook, the South African Reserve Bank, the Competition Commission, the Public Investment Commission, National Treasury, and other departments, DMRE, and Trade and Industry, all have expressed support for an exchange. And there is commitment on their part, that is the government agencies, that if called upon, they would provide the policy platform required for it. The trade union movement has also been very supportive. In fact, in the consultations that we undertook with them, they expressed impatience at what they perceive as a loss of momentum since 2019. However, one of the major challenges is whether the PGM market would be capable of adapting to an exchange, and this is the nub of the matter. It is the producers, as would agree, the processors and equipment manufacturers who determine trade flows and manage the physical product. And they would thus be core in guaranteeing the exchange's liquidity.
For mining news as it breaks, stay logged on to miningweekly.com and register for our free daily newsletter.